In my previous video, I started a series where I started talking about deal execution. And a critical aspect of deal execution that we started looking at is the term sheet, where we try to explore all the different terms and conditions that venture capital firms will want to integrate into an investment terms, mostly as a way to improve the economic returns from the investment and also improve the ability to control certain decisions within the firm. In this particular series, I'm going to be doing a more deep dive into the economic terms and then the control terms that VCs tend to include when negotiating term sheets. Now, for ease, there are so many economic terms to look at, there's so many control terms to look at, but I've decided to bring them down to those essential few that you need to understand. So for the economic terms, I'm going to be looking at valuations, employee option pools, liquidation preference, anti-dilution, vesting, and then pay to play. For the control terms, I'll be looking at board of directors, protective provisions, and then the drag along rights. So without any further ado, let's get started. So the first one, valuation. Valuation is a very critical aspect when it comes to term sheet negotiation, and to a large extent it affects the economics of a particular investment. Reason being that the valuation that is set determines the price for which the investor is going to be paying for that investment. If the valuation is high, it's beneficial to the startup founders because it means that to receive capital, they are going to be given less ownership stake in the company. But that is not the case for investors. Investors mostly want to invest at a lower valuation because that tends to give them more ownership stake at a lower amount of money. And overall, at the time of exit, it gives them access to more proceeds in the investment. Now, one aspect I would like to concentrate on is stating the fact that it is always very important that at that point of negotiation that you're able to be clear whether the investment is going to be done at a pre-money valuation or a post-money valuation. This is very critical as it impacts on the sort of ownership stake that you are going to be giving up in the business. So now let's take an example. Imagine a startup that is raising $5 million and the pre-money valuation is $10 million. What that means automatically is that the post-money valuation is $15 million. Remember from our previous video that post-money valuation is just you simply adding the amount that you're raising for that round to your pre-money valuation. So in this case, the post-money valuation is $15 million. So it's very important that you are clear about whether the investment is going to be at the pre-money valuation or at the post-money valuation. Sometimes VCs will want to invest at a pre-money valuation because that sort of gives them a lower price. But founders, it is more important for you to negotiate that the investment is done at the post-money valuation. So now let's look at the impact that is going to have. So let's imagine that the VC invests at a pre-money valuation of $10 million. Now they invest $1 million. What that means is that they are going to be getting 10% ownership stake in the company. That is a lot, right? But if that same investment was done at a post-money valuation of $15 million, their $1 million investment gives them 6.67, approximately 6.67% of the company. So it's very much important that as a founder that you are clear as to whether this is going to be at a post-money valuation or a pre-money valuation. Then the second aspect that I would like to talk about is employee option pool. Now, employee option pool is very much important and is an aspect that VCs are very keen on negotiating. Reason being that to a large extent, the employee option pool affects their ownership stake and makes them sometimes suffer some sort of dilution. But before that, what is employee option pool? So employee option pool is shares that in a startup that is often reserved for future employees, right? Now, it's very much important because it can dilute the investor stake. So investors are always very particular about how big is the employee option pool and at what time in the investment journey it is created. So the investors will often want that a large enough employee option pool is created before the investment, right? Because if it is created before the investment, it gives them a better understanding of what their ownership stake is, as opposed to when that employee option pool is created after their investment. And if it is created after their investment, it has the potential to dilute them. Now, just to bring things home a bit, let's just go into Excel. Let me show you how this tends to apply. Let's just go into Excel. Let's look at how this is going to apply in reality. So now let's look at this cap table, for instance. So at this particular moment, this is pre-investment. Now, this is pre-investment. So founders at this moment, they have about 82.5% of the company and they own 82,500 shares. Now, let's say the investor holds 10,000 shares for whatever investment they are going to be making is going to give them 10% ownership in the company. So they are going to be receiving 10,000 shares. Now, if the employee stock option pool is created pre-investment, and usually we find that as around 7.5%. So that means that the SOP, the employee stock option, is 7,500. So at this moment, the investor stake is 10% of the ownership, of 10% of the company, so no dilution. But on the flip side, let's imagine that this employee option pool is not created at the time of investment. It is created after the investment. So at the time of the investment or before the investment, this is what the cap table looks like. That the founders, they own 90,000 shares, that gives them 90% of the company, and then the investor owns 10,000 shares, that gives them 10% of the company, right? So at this moment, 100%. However, there's been a provision that 7.5% is going to be created for employee option pool, which means that 7,500 shares will be created for the employee stock option pool. Now, this is what the cap table is now going to look like after the investment, especially when the employee stock option pool fully vests. So employee stock option pool 7,500, that is 6.98% of the company. Then founders 90,000 shares is now 83.72% of the company, and then investors 10,000 shares is now 9.3% of the company. So what that employee option pool has done is that the total diluted shares is now 107,500, and automatically this dilutes down the ownership stake of the investor from 10%, which it was before, to 9.3%. So that is why, because of dilution, investors are always particular about how large is the employee stock option pool and ensuring that it is created before their investment, just to avoid dilution. So that is the second economic terms that I'm going to be talking about. Then the third one that we are going to be looking at is the liquidation preference. Now, liquidation preference is a very, very, very critical aspect when it comes to the terms, and you as a founder, you need to pay critical attention to it. So liquidation preference, mostly you usually find that with preferred stock agreement round. You usually find that when the instrument is like a preferred stock, right? Now, it dictates how the proceeds from the sale of the company will be distributed. Remember, VCs, they don't just like you like that to give you money. They expect that at some point they're able to exit their investment and have some sort of returns, right? Now, liquidation preference sets how the proceeds from an exit, let's say an IPO, let's say an acquisition that happens, how the proceeds is going to be distributed to all the different investors. So now the liquidation preference pretty much gives the preferred stockholders the first right to participate in the proceeds of the investment before every other person is being settled, like the common shareholders, so the founders, the employees, before they are being settled. Now, there are two different forms of liquidation preference that you are going to find, and that is either one we call a participating liquidation preference or a non-participating liquidation preference. And what do we mean when we talk about participating liquidation preference? Participating liquidation preference allows the preferred stockholder to first get a certain to first get their capital back, or not even just, sometimes not just their capital back, but a certain number of returns, maybe 2x of their capital back, before participating with other investors in sharing whatever is left once they have gotten their capital back. While on the other hand, non-participating liquidation preference doesn't create that aspect of them receiving their capital back, but they just tend to participate with other investors in that particular round based off on their ownership stake in the business. So now let's just do a deep dive into the participating liquidation preference. So there are three forms of participating liquidation preference, right? So there is the part of full participation. There also the part of cap participation. And what do we mean by full participation? So full participating stock will receive like liquidation preference of, let's say, 1x of their capital. That's usually the case, or sometimes 2x of their capital, right? And then the share, whatever is now left, is they are also going to participate in the proceeds of whatever is left. Let's say, for instance, that an investor invested $1 million in a business. Automatically that gives them 10% ownership stake in the business, right? Now let's imagine that an exit happens, and that exit was at $10 million. The company was acquired for $10 million. Now liquidation preference specifies that if there is a participating liquidation preference that allows investors, for instance, to get 2x of their capital first, that means out of the $10 million, they are going to be receiving $2 million first. Now what is left of that $10 million is $8 million. Now they are still going to participate in the remaining $8 million based on their ownership stake in the business. So now let's imagine that $1 million investment gave them 10% ownership stake in the business. It means that for the $8 million that is left, they are still going to receive $800,000. So in total, they are going to be receiving $2.8 million as the proceeds from that particular investment. So the rest other investors, like the common shareholders, now have the other amount to share amongst themselves. So that is pretty much what the liquidation preference is all about. Now for the capped liquidation preference, the capped liquidation preference sets a preferred amount that the investor is going to be receiving, let's say 2x of their capital. Now, when participating in whatever is left, there is usually a cap as to how much they are able to receive. Let's say, for instance, that if there is a cap of, okay, you receive 2x of your capital, but there is a cap of $500,000. What that means is that, using the first scenario that we painted, so they've received 2x of their capital, that's $2 million, and then $8 million is left to be shared. Ideally, their 10% should give them $800,000 in that participation. However, if there is a cap of, let's say, $500,000, they are not going to be receiving 800,000. They are going to be receiving $500,000, which is the cap on that particular liquidation preference. So that's pretty much what liquidation preference is all about. And sometimes it may be unfair to founders, because it's possible that an exit can happen, and if there is a liquidation preference, it is possible that the investor is going to get all the proceeds and nothing come to the founders, and sometimes it can seem as being unfair. So it's very much important that good attention is paid. So the third one we are going to be looking at is anti-dilution. So this clause is mostly used by investors if a company issues equity at a lower valuation than its previous round, right? Now, this is usually the case whereby in subsequent rounds, when, remember in one of my videos I mentioned that startups raise money in different rounds. So they raise money in different rounds, maybe a seed round, a series A round, a series B round, and all of that. So ideally, it's expected that as a startup moves across all of these different rounds, that their valuation is going to increase. However, that is not always the case, because sometimes, due to tough market conditions, we saw this a lot post 2021, where valuations were incredibly high because of capital availability. But from 2022, 2023, a lot of startups, they had to take a shave. I remember Stripe even had to reduce their valuation from about $90 billion from when they last raised to like $60 billion for their raise, right, as of 2023 January. Now, that is not usually the case whereby valuation keeps increasing. So sometimes a startup can raise a new round at a lower valuation, which we call down rounds. Now, this can be detrimental to earlier investors, because other now, a down round is not always favorable to early investors, because it means that the early investors will be paying more than subsequent investors that are investing at a lower valuation than the round where they invest. So that can most times dilute the ownership stake of the early investors. So what early investors tend to do in this particular case is to have some anti-dilution clauses. And one common anti-dilution strategy that is being used is what we call a ratchet. Now, a ratchet will have different forms. So there is the full ratchet, and then there is the weighted ratchet. Now, average ratchet. So for the full ratchet, the early investors are able to have their shares convert at the same price as that of the investors in that particular down round. Let's say, for instance, when an investor invested, that the share price is let's say $10 per share. So ideally, when their shares are converting, their shares should convert at $10 per share. Now imagine that in subsequent round, when the startup is raising, they raise at a down round. So instead of $10 per share, their shares are now issued at, let's say, $8 per share. So what a full ratchet does is that those early investors that invested at $10 per share, they will have their shares converted at $8 per share, the same as that of the investors at that down round. So that way they have full protection that their share, they have full protection from dilution. So that's pretty much what anti-dilution clauses tend to do. Is a way for the early investors to protect themselves from dilution should the company suffer. Then the fourth one that I'm going to be discussing is vesting, or the fifth one rather that I'm going to be discussing is vesting. Now, founder share may be subject to vesting schedules which specify the period before which founders and employees will have access to their stock, right? Now, this is usually the industry practice and is a way to get the founders committed. What vesting does is that this number of shares has been allocated to the founders or it has been allocated to the employees, but they only have access to the shares after a period of time. And that allows for both the founders, the employees to be committed to the growth of the business, right? So that it's not a case whereby they have the shares and then after 2 years, after 3 years, they leave the company, right? So what vesting does is that it sets a period for which the founder or the employees will have access to the shares, right? And usually the industry practice is to have a 1 year cliff. That means shares is not going to vest until at least the founders have spent 1 year in the business, and after that it will now have a monthly vesting over, let's say, a 4 year period. So that's like total 5 years, right, for the whole shares to vest, for the employee or the founder to have access to their shares. So it's usually an aspect that VCs tend to negotiate. Then the last one I'm going to be looking at in terms of economic terms is the pay to play. Now, this provision obligates investors to participate in future funding rounds or have their preferred stock converted to common stock. So this is usually very favorable to founders because as a startup, you are going to be needing capital as your business grows, right? So maybe you raise the seed round and you need to go to a series A round, you need to go to a series B round and all of that. So this particular provision forces the investors to commit more capital to the startup to maintain their ownership stake as they move along this funding round, because sometimes you may have an investment, right? You may have not an investment. So sometimes you may have investors invest in you, but they will not want to invest in subsequent rounds. And that means whenever you need capital, you need to constantly go out in the market and raise from new investors. That can be exhausting, that can be stressful. So this pay to play provision obligates the already existing investors to follow you on, to invest in subsequent rounds to maintain their ownership and stake, or if they don't, their shares, let's say the preferred stock shares they have received, gets converted to common stock shares. So just so that this video is not too long, I'm going to be pausing it here for now. In another video, I'll now talk about the control terms. So remember, this is Miracle in Nigeria. Do not forget to hit the subscribe button and always visit this channel for more about VC related content. Thank you so much.